Greetings trader, welcome to my trading journal again. Today I am going to talk about my new trade. I would like to record to my trading journal that I have been maintaining with this series. So if you have not followed the previous videos of this particular series, I would recommend you to go and watch it. So what is this trade? So this trade is called as poor man's covered call. I'm going to talk about it in detail in the later section of this video. But what exactly it does is I have basically gone long on 1700 call, which is of December expiry of 2022. I'm long on that particular call, and I have shorted this 18,000 call, which is of current expiry. So what is basically what this trade is basically, it's a calendar spread wherein my short call and my long call are of different expiry, right? How am I going to benefit out of this particular trade is something which I'm trying to explain now. So let's understand why this is called as covered call or poor man's covered call strategy. In order for us to do that, we should know what exactly the covered calls are, right? So here is the definition of covered call, right? The covered call strategy combines the purchase of shares against which you have to buy or you have to sell some options. To trade a covered call on a particular stock, an investor would need to purchase at least one lot of it, right? That's the book definition of covered call. And here is how the payoff of covered call looks like, right? Even before covered call, let's talk about what happens when you buy a stock, right? So let's say you maintain a bullish stand on some stock and you have bought it, right? What would happen? Let's say if you have bought it at this particular price, if at all it goes above that, you are going to get some profit. If it starts trading below that, you are going to incur some losses. But then you are going to get some profit or incur some losses. All those things are kind of notional. Unless and until you book that profit or you book that loss, it is not your profit or loss. That is one of the kind of disadvantage of buying a stock, right? Unless and until you realize it, that particular profit or loss is not yours, right? That exactly what that is one of the disadvantage of buying a stock, and that's exactly what is eliminated by covered call, right? So the prerequisite for covered call is again buying a stock, one lot of stock here, but then additionally you short one particular strike which is, let's say, 5-10% above that particular spot. In that case, what you will do is, even if your your stock goes up or down, you are going to get some profits on your covered call. If your stock expires below that particular strike for that particular expiry, that's when you are going to earn all the points that you have shorted when you shorted a covered call, right? And that's a realized profit that you can get on your covered call, right? So it's that is something which we call it as covered call, right? So but then prerequisite is you need to have a very good stand, or you need to have a very good stock, and you should maintain, or you should purchase at least one lot of it, right? But then in order for you to purchase that one lot of stock, for example, if at all you want to open a Bajaj Finance covered call strategy, you need to own one lot of Bajaj Finance stock, which is a very costly affair, wherein you need to invest, or you need to deploy almost 10 lakhs of capital over here to earn rental income of 2,000 or 5,000 rupees, which is again a very good risk reward or good return on your investment. But then if at all you don't have that much money or that much capital in your account, then that's a problem, right? So that's exactly what that particular disadvantage is, what is being eliminated by having this poor man's covered call strategy, right? So what does it say? The poor man covered call strategy, which is targeted investor who are poor, not literally poor here, but then one who does not wish to commit large amount of capital into a strategy. So how do we open this poor man covered call strategy? Is having an instrument which acts as a underlying, which acts as a future, which acts as a stock, right? And who better than in the money call option can act as it, right? So for example, I have this in the money call option over here, which is having 80 or 90 percent of delta here. What does that mean? So whenever my underlying, which is Nifty, moves 100 points, my underlying is going to move 80 points, right? So it will act as your underlying with you don't need that 10 lakh of rupees that we have seen in the Bajaj Finance example. You don't need that. You just need this 1 lakh rupees to go long on this particular index option. This 1860 into 50 is what I will be needing over here. So this will act as my underlying, and this is the covered call that I am shorting on week by week basis, right? So now there are a couple of things which could happen, right? What if my underlying goes down, right? If at all it goes down, you are going to collect all the premiums that you are shorting with these weekly expiries. So for example, now this December expiry is a very long dated expiry here. From April till December, if you count, there are more than 35 expiries that we will have an opportunity to short close to ATM options, wherein we can collect good 90-100 points every week on week basis to recover all the losses or all the premium that we have we are long on, right? So that's the strategy. In case now the second probability is, what if it goes up? If at all it goes up, we are going to get some reward over here because we are long over here, but then this particular option or this weekly option, they will be kind of threatened with that. But then again, adjustment to it is, if at all it goes up, you can roll up your calls depending upon the movements in the underlying. You can roll up or roll down these calls to get additional rental income on week by week basis. So that's the overall strategy here. If at all you do not have lot of capital in your account and you really want to generate steady rental income on your portfolio, that is exactly what you can do. But then let me just remind you, this is a very directional strategy. If at all you can if at all your underlying moves or slides down further, you need to keep adjusting this position by shorting or rolling down your call and collecting additional premium to match with the delta of this long call here, right? So this is the trade which I wanted. I am looking at a loss over here, but then I'm not worried about it, because again I maintain a bullish stand on Nifty. I certainly feel by December 2022 we will at least see 19,000 or 18,000 18,000 points on the Nifty index. If at all if our hypothesis holds true or stands true here, we are going to get a lot of profit on this particular call, and we'll see how to adjust those bleeding calls in that case over here. We'll maintain some distance from the spot in case Nifty goes violent from here and really goes beyond 18,000 or 18,500. That is something which we really want this to happen, because this is a strongly directional strategy, and that too a bullish strategy, wherein you really want your underlying to go up, and that's when you are going to realize maximum profit. But then in case it goes down, you have these covered calls to generate all the premiums that you are losing over here, right? Because you are a option buyer here, you are going to lose this 1860 points. You know, if you see, if you consider intrinsic and time value of this particular option, I went long on this option when Nifty was trading at 17,850. That's when the intrinsic value or the time value of this particular option was, you know, 1000 rupees. And I plan to generate or get those 1000 rupees in 10 subsequent expiries to make this entire strategy a lossless strategy, right? Even if it goes beyond 17,000, I will see how we can be more attacking in that case when rolling down our call from 18,000 to 17,900 or 17,800 and so on and so forth. So I just wanted to record this to my trading journal and let you know what covered call strategy is and what is poor man's covered call, how it is different from covered call. I may be completely wrong here in understanding these both these strategies, covered call and poor man's covered call. If any one of you feel that this is not how it is done, this is not how you should adjust it, please feel free to comment that out on this video so that I can also learn here. So thank you very much for watching this video, and if you really like the content on this channel, don't forget to subscribe this channel. Thank you very much.